Hello, everyone. Welcome to another episode of the Western Sydney Business Podcast. It's nice to see things are getting back to normal amidst COVID-19. Today, we are joined by Mr. Tuan Duong, who's the principal of Duo Tax Quantity Surveyors. G'day, Tuan. How are you?
Good, thank you. Good, thank you, Thomas, and thanks for having us on today.
It's my absolute pleasure. So we were connected through a mutual friend and a guest I had on the podcast, Matthew Sartori, another Southwest boy, and he thought it would be great to have you on this podcast. So a bit of a summary: you're a Southwest boy, born and raised, and you started a business in Canley Heights 5 years ago. It's Duo Tax Quantity Surveyors. So do you want to give the audience an overview of Duo Tax and where that business is 5 years later?
Yeah, sure. Thanks, Thomas. So I guess the journey for myself is that as an individual, being young, I actually didn't have a lot of. I had a passion to help myself get out of something that I was really comfortable with in terms of a career in civil engineering, and then I kind of found an interest in property. Started delving into property myself. And that's when I learned about tax depreciation through my tax accountant. Going to see an accountant, then, of course, you get the advice about, hey, let's get negative gearing happening. Let's get tax depreciation happening. And that's when I sort of, my ears sort of sprung up and thought, oh, this is great. Tax depreciation, on a brand new duplex at that time that I had bought, yielded thousands of dollars in tax refund for me. And I thought, well, that's a great way to save money. Through just having an investment property, and what an advantage that is. So then I decided to change my career as a civil engineer and make a change into quantity surveying. Quantity surveying being a construction economist, which is like an independent advisor of what construction costs on various things are, whether it's a subdivision or building high rises, or helping the banks out or helping the council out determine the construction costs on different type of developments. So then because I had a quantity surveying construction background in university, I decided to leverage on that again and then take up a role in quantity surveying. I did that for a couple of years before I delved into tax depreciation. It gave me a bit of a background. Getting registered with the tax board gave me an advantage then it gave me an opportunity, should I say, to then start up my own business and then help not just myself, but I wanted to help people like me, other property investors out there, delve into property as well, and then learn about the benefits of investing in property. And advising on tax depreciation was one of those ways I could help people. And so the value that brought, I then decided that Duo Tax would be the vehicle that would take me through to the next 5 years to help not just my staff, but grow a business out of it, but help thousands. So to date, we've helped maybe 15 to 18,000. I think it is the last recount I've had on how many investors we've helped Australia wide. And it's really just a passion for property that it comes down to that's helped us get from where we are 5 years ago to today to become a business that focuses purely on just advising on property.
And so you started in Canley Heights, and then you just mentioned clients all across Australia. So how has this business grown from that point of view, from starting in Southwest to now being Australia wide? Is it?
Yeah, that's right. So we've got offices in Sydney and Melbourne, but when clients and property investors, should I say, be referred to us by people like yourself, people like Matt Sartori, we then go out to their properties, whether it's in Perth that they buy, or Darwin, or as you know, Tasmania is even a popular spot. We've got inspectors and valuers that all help us all across the country to get these reports done. So inspecting the property, getting it through to a stage where the accountant can have that report ready for use. And how we got there, I guess it's something about where I started. I thought, well, I'll help Sydney investors like myself in my own networks get tax depreciation advice. But then I realized that people were buying everywhere, so I had to find a way to say, well, I've got to expand my horizons outside of just my network within the Southwest Sydney. But to date, regardless of where the business has come in the last 5 years, majority of our business, at least I would say 50 to 60% of our business comes purely from the Western Sydney suburbs. And that's, we're talking from anywhere, some businesses in the Shire, but majority of businesses at the Wetherill Park fringes, sort of through to Fairfield, Campbelltown,
Mhm.
Parramatta. Like that's just the biggest market of our business, and I think it's something to do with the breakup and the demographic of where we live,
Yeah.
and being myself as a person that I grew up in Cecil Hills, and formerly Cabramatta and Bonnyrigg. My networks around that area are very strong, and so I've
Mhm.
leveraged on that. And the people around there are always willing to help each other. That's just something I found
Yeah.
along the way. Yeah.
That's the culture in the community. I have a question.
Yeah.
When working Australia wide, are the principles the same when reviewing a property from a tax depreciation point of view from Tasmania, New South Wales to WA?
That's correct. That is exactly the case, Thomas. And because tax depreciation is legislation that is legislated from the federal government, so at a national level, it all, as you know, tax legislation is nationwide. We then apply the same principles, except obviously with varying construction differences in the cost of different assets at different points in time, especially if you're delivering if you're delivering steel in sort of Ballarat versus Metro
Yeah,
Melbourne,
yeah.
you're going to get different rates of construction, but the principles of depreciation remain the same.
Understand, that makes a lot of sense. And from a
Yeah.
property point of view, how have you seen Southwest Sydney change from property, from culture, from investment? What are you seeing on the ground when you're speaking with people that want to start buying in these areas?
So I think the biggest changes have been that so 2015, we started the business. In 2017, there was a huge legislation change. So it was probably my first time going through change in a business and
Yeah,
understanding what it takes to be dynamic. And so because of the huge change, property investors were affected hugely, where you could buy a 1950s or 1960s property back in 2016-15 up to May 17. You could purchase a rental property and you could depreciate just about everything. Even if it was an old building, you
yeah,
could depreciate that ruddy carpet or whatever it might be, that
okay,
almost fully diminished oven. And you could still depreciate that secondhand asset, even if you were the fifth or sixth or seventh owner of that property. That's how it used to be. And then the legislation came out and they said, well, no more. We can't have people overvaluing secondhand assets time and time again. So
yeah,
we're going to stop that. And from now on, we're only going to allow you to depreciate secondhand, brand new assets purchased from a builder or purchased from a retailer, and it has to be used at the first instance as a rental property or a rental asset. So then a lot of investors were affected by the depreciation, but that's taken some time. It's been 3 years since that rule rolled out. And now what we're finding is people, including myself, they are buying more brand new properties than ever. So there's this
right,
huge push. So I think one of those things is the government is always trying to, stimulate new construction. And I think it's one of those tax legislations that they implemented to make sure that people reduce the chances or the likeliness of someone investing in secondhand property and
mm,
get them to start buying brand new, right? So depreciation has been disadvantaged. So at least let's go buy brand new. We can depreciate all these brand new assets, get these huge depreciation values per year of $10,000 to $20,000, and it makes a lot better value for people, and people will start buying new property. And I think that's working to some degree. I think the Austral areas, the Leppingtons,
mm,
even if the Gordon Springs, people are buying in these fringes and investing, and that's what the government wants to do, and it's stimulating the economy. But prior to the COVID anyway, until they've
yeah.
released, they've confirmed the $25,000 grant, but that's there, I believe, to stimulate new construction and renovations and things
Yeah.
like that as well.
Interesting. I think you touched on. I was going to ask: is it successful? And clearly, what you're seeing, it has been prior to COVID. So, just I want to step into the tax side of things. So, anybody listening to this, can you explain depreciation and how it pertains to investment and tax on a property for somebody that may not
Sure.
know?
Sure. So you've bought a rental property. The ATO realizes that with an investment property, you can leverage on the property by claiming deductions against the income. So you receive rental income every week. Now, over the period of the year, you're going to incur expenses, things like maintenance, things like your water services levy, your council charges, and you also have your loan on your interest repayments, right? So the interest on the loan, you can claim that as a tax deduction. So if you've got $20,000 worth of income a year, you might have $15,000 of deductions. So that means, which includes your interest, your council levies, and your water charges. Well, then your $20,000 reduce. You take your $15,000 off of your, all your costs. That leaves you with a positive only $5,000. So you only pay taxable income of $5,000. So that's what they say negative gearing. So you're claiming all the deductions on that property. Now, on top of that, the ATO has also allowed or legislated since 1997 that you can also claim depreciation of the building on that rental property, whether it's the granny flat, whether it's the house at the front. You can claim the depreciation on those buildings. Now, the building is claimed at 2.5% on a rental property. And if you've got a hotel or a small motel, you can depreciate at 4%. So there's some variances in that, but majorly, majority of the time, it's 2.5% on the building. But then on top of that, if you've got a brand new property or you've purchased a brand new oven, you can also depreciate what they call plant and equipment. Okay, so plant and equipment will include things like your carpet, your oven, your range hood, your ceiling fans, your air conditioners. Now, prior to the 9th of May 2017, if you had a second-hand property, you could actually claim depreciation on the plant and equipment. But post 9th of May 2017, if you exchange contracts on a property, you can claim depreciation on just brand new assets. So the brand new oven, the brand new range hood that come with a brand new investment property that you build from your builder sort of in that local area, they will allow you, the ATO will allow you to claim the depreciation on those assets, and that's claimable over 40 years.
And if, let's just say you own an older rental property at the moment and you bought a new oven, you fitted it out for the tenants, can you start claiming that in the depreciation on that? If it's an older property. So if it's an older property and you as the landlord, you buy a new oven, you put some new carpet down, can you claim deductions on that and depreciation?
That's correct. That's correct, Thomas. You can actually do that, and the ATO will allow you to claim depreciation on those secondhand assets because, the brand new assets that are installed in a secondhand property, as long as it's purchased from a retailer. It can't be off Gumtree. It can't be secondhand in that nature. It has to be from a retailer where you pay GST.
Understand. And is there any property asset class where this does not apply to? And I've sort of, so I do a lot of land transactions around the Western Sydney airport, land banks sort of stuff. Some have houses on them, some do not. Does this apply to any asset class, or is land excluded, for example?
Correct. So it's only anything that is sort of man-made, should I say, would be depreciable. So things like your bricks, mortar, slab, framework, roofing structure, anything to do with that would be depreciable. The land is not. The ATO does make some clear distinctions in that. If you were excavating, for example, if you're excavating for the purpose of putting down a slab, laying down your slab, then definitely that you could depreciate that excavation component. But if you were excavating to clear out a tree that you didn't like, part of that investment property, that is not depreciable. Same thing goes with landscaping. So you got landscaping that's hardscaping, which is your retaining walls, your fences, but things like your turfing and plants are not depreciable because they're natural. They're appreciating or natural in the environment.
It's good. I like that you put it, anything man-made. It sort of sums it up. You can look to depreciate that.
Correct.
And so what if, I know we touched on it briefly, but anything else, if somebody else already owns an investment property, can they still seek to yield benefits from depreciation other than putting in a new oven or all those sorts of things? Is there anything else people should know?
Yeah, definitely. I think there's a couple of things that's really important is that if you've got an investment property and you don't know about depreciation and you've seen your accountant and they've forgotten to mention depreciation, the ATO lets you go back and amend 2 years of tax returns. Okay, so if you've got a property you bought in 2017-18, and then you go do your tax returns in September 2018. From September 2018, you have up until September 2020 to amend your tax return. So you've got another 3 months if you bought a property in 2017-18 tax return year, and then so from the date of notice of assessments, once you get that receipt from the government to say that you've lodged your tax return, which is the notice of assessment, they've got 2 years to amend that tax return. Anything outside of that, so if you bought purchase property 15-16, that means you can only go back to the 17-18 year.
Understand.
Okay? So I've got, yeah, so definitely it's worthwhile to go back and have a look. And I think it's a simple question as, can I claim anything? So we have a lot of clients that I guess that would come to us and refer to us, and we would ask them, okay, well, what's your address? When did you own we'll find out through RP data. There's lots of sources these days where we can find out information about property and ownership details. We'll use that to find out exactly, okay, well, how far back can we go? How much depreciation can you actually claim? That way we can actually do a feasibility check for the client to see if it's even worth spending the $500-600 for a residential property tax depreciation schedule. So that's one of the benefits of just inquiring with a quantity surveyor if you're unsure.
So definitely do it. What are some other key tips you can offer investors in the market right now? Should they be looking at, for relation with depreciation or investment that you maybe commonly see people not do?
Definitely. One of the things I think people are really become a little bit unstuck is buying brand new properties and living in it. I think that it's always because of the new legislation where if you buy a property that's brand new and you live in it for 6 months for some potential CGT benefits in the first 6 months, and then you decide to rent it out, it's always worth remembering that you do lose all the depreciation on the plant and equipment. So say, for example, you got a $250,000 building price, 40,000 of that or 50,000 of that might be plant and equipment. We have to remember that the $50,000 is immediately omitted from any depreciation claims once you make that an owner-occupied property at the first instance. It has to be a brand new investment property at the first instance for you to claim the full $250,000. But that's not to say, even if you do live in it for the first 6 months, because of the other benefits like your first homeowners grant, your CGT benefits, your capital gains tax benefits for the listeners that don't know, but that's something you want to speak to your accountant about. But they're the benefits you can have, but you do omit some depreciation. Sometimes that can be better value to just forego the depreciation on plant and equipment and just claim the $200,000 in building depreciation. Not as beneficial. Your depreciation is going to be a little bit lower, but in the end result, you will have a better outcome when it comes to CGT benefits, potentially. Something you want to speak to your accountant about to crunch the numbers to see what works for you. But that's something that I think a lot of investors that come through, they get a little bit shocked that how come the depreciation is not as high as as my friends or someone that recommended me? But it's something people are coming to terms with the legislation change. Something I would suggest with looking at property, a lot of people don't know that substantial renovations now is also included as a brand new property. That's as part of the GST Act. Right. So if you buy a property that's got a new kitchen, new bathroom, new framing, new paintwork, new facade, but it's still the same in nature in terms of its physical appearance and physical structurally the same, then you can still depreciate as a brand new building. So that's something that clients would know. And I think a lot of older homes, especially sort of the inner west sections of Sydney and the sort of, the older suburbs of Sydney, they're undergoing a lot of that, where, builders and renovators are making the most of that. And so those properties there are yielding good depreciation because of that brand new nature that they've reinstated in that building. That might be whatever it might be, heritage listed or whatever it could be. There are still benefits there, Thomas.
I want to touch on something that pertains to millennials, I suppose, and buying new homes and, young 20s-ish. Your thoughts, you mentioned living in it for 6 months versus, the depreciation you may get from an investment asset. What are your thoughts on that? Should you buy it and then just live in it for 6 months and then rent it out? Or should you just, yield that upfront depreciation benefit? Can I get your broad thoughts on that?
Yeah, for sure. Now, this does pertain to accounting advice, but this is from my experience as an investor. As an investor myself, my first property, I lived in it for 6 months. I claimed less depreciation. Sorry, at that time there was full depreciation, even if you lived in it after 6 months. So putting myself in someone else's shoes that will be a first-time investor today, living in the first 6 months, you would claim less depreciation. You'd forego $40,000 depreciation, but which is claimable probably over the first 10 years. Now, if you think about that, $40,000 over 10 years. If you lose that, you got to think about the benefits of buying a property, say in Austral, that like a client of ours did the other day for $600,000. $600,000. Now, I think in 10 years, that property may be worth potentially, and I think this is a good case scenario, at least $900,000. So we're talking about $300,000 of capital gain. Okay. Now you've gained $300,000 of capital gain, but your first 6 months, 10 years, you lost $40,000 in depreciation. So $300,000 versus the $40,000 in depreciation. I think I know which way I'd go. That's my experience. That's something I would do if I was advising as an investor. And I think that's better value, especially in my circumstances. I would say that that's a lot beneficial because I'd want to hold property, especially in Sydney, for a 10-year period, because there's a huge advantage there. And I think as much as it is important to negative gear and make the most of those tax incentives, it's not always those reasons that we invest in property. There are other reasons like the high yield, the high capital growth. We do want that, and sometimes that's more important. So something to speak to an accountant about if you're unsure, especially based on your circumstances.
Fantastic. It was awesome. Are there any upcoming government policies that investors need to be aware of? Like the 2017 one. Is there anything on the horizon for the next 5 years that people need to note?
I think the 2017 budget was a big change, especially to drive the construction side of things, brand new construction. And then as we went through the 18, 19, and then 19, we had the federal election. And the federal election, obviously, as a lot of people know, that Labor was really pushing the agenda without to move forward without negative gearing. And that was a big topic on their agenda. But I think since the election of Liberal having the favour there, we've gone to, I think that subsided somewhat, the negative gearing, talk about investing. And I think investing in property, negative gearing and having those deductions helps people a lot to get ahead, because if you weren't including interest and those type of deductions, it changes the formula to why you would buy a property. And it makes it very difficult for people to buy property. And I think ever since then, the federal government has also then got rid of travel. So you couldn't travel interstate to go claim your travel expenses, going to look at your investment property in Brisbane from Sydney. And so little things like this, and they were actually saying in the 2019 budget that on their agenda was property investors, people with 5, 10, 15 properties, that they were going to sort of, try to catch them out on, all those deductions and things like that they were trying to put through. But I think the biggest movement is now with the COVID happening, I think they're going to try to help people get ahead wherever they can. I mean, part of their stimulus is to try get people to spend. And if people aren't spending, then they're not going places. And I think fortunately for property investors, it's a great time to thrive because the government just wants people to get out there and spend money.
Buy property. That's all they're wanting people to start doing now.
Correct. Yeah, they want people to drive construction, and hence the $25,000 construction grant for people that earn less than $150,000. I think it's a great incentive.
No, fantastic. Tuan, I think you've given us an absolutely epic overview of the depreciation world and property, your business, yourself. I've had a great insight here. Anything else you want to leave us with before we wrap up the podcast?
That's it. I think I've wrapped up a lot of the points that I wanted to talk about. I think there's huge benefits being, especially I think your listeners out there, Western Sydney, upright. It's such an area that has so much potential. Now that myself growing up in Cecil Hills, now looking at where that's taken off, and having the airport come, I think it's going to bring huge potential all the way from, I think, Parramatta all the way down to the sort of Campbelltown region. There's just massive potential, and as a business, as much as we're expanding our horizons, our core of our business is always focusing on people locally. And because I think the local demographic of people do so much for this region, not alone, but also this country. I think it's a great place to be. So I encourage people out there, if they're young and they're high on spirit, and they've got entrepreneurial spirit, get out there and definitely make the most of it. It's a huge opportunity out there, especially in this region of Sydney.
Yep, excellent. Tuan, thank you so very much. I look forward to having you on
Tom.
another episode of the podcast.
Cheers, appreciate it.
Yeah, bye.